Hello and welcome to the House Geeks Real Estate Show, where you will learn the smarter way to buy and sell homes. Today's show will be on the mortgage market. And since Kirk and I are not loan officers, we decided to have one here with us. So let me introduce Chad Priebe from Bell Bank and Mortgage.
Thanks, guys. Thanks for having me on today.
You're welcome, Chad. So why not hang out with us for the next few minutes and be a house geek with us? We do have another class coming up that continue to grow. This one will be on Wednesday the 22nd at 6:30 at the Richfield American Legion. You can reserve a spot on Facebook, so check out the Little House and Glasses on YouTube, on Facebook, where you're currently at, and you can reserve a spot. You will also receive our new and improved The Smart Home Buyer 2.0 with 10 additional pages. And remember to check out our webpage and YouTube page to dive a little deeper into these real estate related topics. I believe our YouTube page is now up to about 100 videos.
Yeah, something, it's growing.
Yes,
Each
it
show
is.
grows by one.
Yeah.
It's very nice.
It should work. Let's try that. Claims that it's been shared. Let's see if it's been shared.
Are we even recording?
We are recording. Yes, I know that to be the case. I'm just trying to make sure it actually shared successfully.
Ah.
Keeps saying we'll get there.
So first we'll start out about talking about the interest rates. Then we'll get into the different types of mortgages that are out there. And then we'll get into how to properly shop for a mortgage and what to avoid when doing so.
Share on my timeline. There we go. That looks like it's going to work now. Let's verify. All right. Bear with me, Facebook. I'm dealing with Facebook, so it's okay. Fix that later.
This show should be easy. We have an expert with us today.
Absolutely.
All right. Here we go. Are you thinking of buying or selling a home, or just want to know? Well, you know what? This would be better if I actually had this stuff plugged in correctly. There we go. I knew something wasn't correct. Let's fix that. Try this again. Please hang up and try again. Here we go. Are you thinking of buying or selling a house? Or just want to know what might be going on with one of your biggest investments? Well, then why not become a house geek? Hi, I'm Kirk Duckwall, here with Chad Vandelot. Welcome to the House Geeks Real Estate Show, sponsored by Bricks Real Estate, Network Title, Chad Priebe and Eric Bloomstrand with Bell Bank Mortgage, and James Tolson with Country Financial. If you have any questions for us, give us a call at 612-207-5388. Again, 612-207-5388. Or you can check us out online anytime at housegeeks.com for the latest and greatest home searching and researching tools. Also, follow us on our House Geeks Facebook page, where you can see upcoming events, classes, or watch us record live most Tuesdays at around noon. Also, check out our YouTube page as well, where we have over 100 videos now of all sorts of information regarding Twin Cities real estate, how you can become the smarter home buyer or home seller out there. All right. Today, we're going to be talking about the mortgage market. A lot of changes have occurred. Things have come up over the course of the last year since the last time we have addressed this subject. I want to thank Chad Priebe with Bell Mortgage for coming in today to chat mortgages with us. Thank you.
Yeah, thanks for having me, guys.
So, the one big thing, the real driver in the market, I was saying that, the showing activity has been slower going back almost 10 months. And it wasn't until the interest rates started to become this ski slope from where they were at. What was that? Started sliding last October or so?
Right around October, yeah.
Yeah, and that's when we started to see things finally start to pick up again. I think October was probably the slowest month that I had personally seen in the real estate market in quite a while, and I would hate to see where our market is now if that slide didn't occur, because I think that really was a driver of our spring market.
Big time.
And we have seen that that showing activity has picked up a lot. Kind of right now hovering very close to where it was around the same time last year, but that was not the case going back to that October timeframe. So there's a lot of different options out there. Actually, I'm going to make a note here because we didn't even mention portfolio, and that's really kind of come around a lot in the last year and a half. I think we brought it up on the show previously, but I want to kind of dive in on that one a little bit too. But kind of covering some of your basic options out there, and then maybe we can get more in depth with some of the newer products that are available out there.
Sounds good.
When we talk about products, I know there's a lot of fear in the marketplace based on, what happened in 2008, that, when they say products, is this predatory loans, is this high interest rates, is these ARMs that are going to not be good? No, because the guidelines, a lot of them are still applying, with these new loans. They're just new options. They're reworked options of stuff that have been out there, just creating different possibilities for people in different situations. Because, not every, despite what some lenders like to tell you, not every buyer is going to fit into this perfect little box, right? And so
the key is to start early. Start early and shop around and have your information together so that a good loan officer can look at your information and actually choose which one fits your personal situation and your personal goals.
Right, and starting early is so important, right? If you're worried about, credit impact, we'll talk about that a little later, but that's should be a minimal concern in your mind. Basically, I'd put that to the back of, and not worry about that as a primary concern, because all that can be gained by, starting that process early on, fully starting the mortgage shopping process early on is far more important than worrying about a couple points that'll roll off your credit pretty quick anyway.
Yep. I'd say you guys hit it right on the nose. I mean, the more educated you are when you start the process, the more beneficial it's going to be for you when you're ready to make an offer.
Well, yeah, it goes back to the book, and one of these days we'll get that new book once we get it from the printer and go over it on air here. But that there is a order that you want to do this in, and if you do this right, I kid you not, you can save tens, if not hundreds of thousands of dollars if you know what you're doing. Planning, I should say, potentially save, depending on what you ultimately choose. But understand,
and how long you stay in your home.
Right?
Exactly.
So, but at least you then know what exists. If you're hopping online, clicking buttons and letting the computer shop for you, I'm sorry to say that's really not the best way to do this. This is what the TV wants to tell you is the best way to do this, because they make money.
Yeah, but can I get pre-approved in 10 minutes or less?
Yeah, you could, but is it going to be worth the paper it's written on or email that it's sent through? That's the real thing. Okay, products. What loans are available? So FHA. A lot of people think first-time home buyer. No, Federal Housing Agency. Can you kind of give a breakdown, Chad, of what FHA general guidelines are?
Yeah, absolutely. FHA it's a good product. It's designed for someone that has, usually a credit score down to a 620. We do have some exception basis at Bell that will go down to a 600 credit score, but it offers a low down payment of 3.5%. And it's a little more lenient with your debt to income ratio qualifying requirements. So, It's a good product. When you're looking at condos or certain property types, it's something that we want to go into a little more depth about because that could create a roadblock down the road. So,
Right, creates a limiting factor.
Correct.
Potentially,
Yep.
yeah. You know, and okay, I'll get to that in a minute. So there's some offshoots of FHA with the MHFA, but we'll talk about that in a second. So then you have conventional, right? And conventional, you know, a lot of people think 20% down, but that's just not the case. Actually, you can get loans that are even lower. Well, straight conventional, 5%, right? Standard.
Correct.
Standard, yeah.
Yep.
So
we do have programs now where we offer, it's called a Home Ready or Home Possible. Home Ready is offered by Fannie Mae. Home Possible is by Freddie Mac. These programs are awesome because they allow you to put as little as 3% down. And you don't have to be a first-time home buyer.
right.
So great opportunity. If you don't have a ton of money in the bank, but you're looking to get yourself into a home and start building that equity with minimal down, that's a great opportunity for you. And the rates are really low.
Yeah, now Home Ready and Home Possible, if I remember correctly, in comparison to MHFA, a little bit more flexible on the maximum income that somebody can earn.
Yeah, there is the median income, depending on the city and the county that you're purchasing in, there's an income qualifying tool that we use. So there are certain cities, like there's parts of St. Paul and Minneapolis that don't have income limits.
Yeah, I've seen that on the map.
Yep. So it gives you a good, I mean, you could be a high income earner, but still qualify for that 3% down program.
Right.
Yeah, one of those spots is over in the Selby area, Selby and Dale area, where it's,
That's really popped.
you know,
Yeah. They look at it as a kind of a stressed area maybe at one time, or maybe there was some damage there through storms or something like that. So there's no income limits.
You know, one thing that I find interesting, you know, Home Ready, Home Possible, that and MHFA, that sometimes, you know, if there is low down payment to be had or down payment assistance to be had, doesn't always mean it's the best choice. And we can get into that a little bit more in a minute. But let's talk about MHFA because that's like the lowest down, right? Besides rural development.
Correct. Well, you're still going to have your standard. So MHFA is, you still have your standard, you know, Fannie or Freddie product, or FHA first mortgage followed by your down payment assistance second mortgage. You still have that 3% down, 5% down option. The MHFA, the benefit there is if you have the qualifying credit score, but just don't have a lot of money in the bank. I mean, their minimum requirement's $1,000 out of pocket.
Right.
I always prep everybody $1,500 out of pocket in case there's a little bit more. But the MHFA product's going to be a good product for, let's say, someone that has a household, you know, 2 or 3 kids. You know, they're working a full-time job. You know, they're paying $1,600 a month in rent, but they can find themselves a nice property, single-family home, whatever it is, and own their own property and start building their own equity.
Right. I mean, we got a couple clients out there right now. It's exactly what they're doing is shopping that. You know, they're paying these ridiculous rents,
Right.
and yeah, you can own and pay less. You know, when we come back from our commercial break here, we'll get into another MHFA product, which is the Step Up program, which, as far as I just found out about it not too long ago. And that's basically a second-time home buyer program or a third or whatever.
Correct.
You can keep using it. Also get into rural development, DVA, and portfolio loans. I'm excited to talk a little bit about that. If you have any questions for us, thinking about buying or selling a house, give us a call at 612-207-5388. We'd be happy to help you out. Even after the show, you can hit us up, 612-207-5388. We'll be right back.
I put the cart before the horse. Talking about the cart before the horse.
Are you ready?
Let's do it.
All right. By the way, I forgot to tell you, when I start doing this, it's like 3 minutes, 2 minutes, 1 minute commercial break. I didn't do it to you because I didn't want to throw you off this time, but usually I'll throw up. Like when I go like this, I'm not throwing out peace symbols.
Yeah.
That means we got 2 minutes.
Yeah. Okay.
All right, you ready? We're going to go back. Here we go. Welcome back to the House Geeks Real Estate Show on AM 950. Today, talking about the mortgage market, different mortgage options that are out there. We're going to get into some mortgage myths as well. We kind of started out discussing the interest rates and how much they've dropped, almost a full point over the course of the last few months, and making it a very good time to be out there if you're looking to make a purchase, or maybe depending on when you bought, looking at refis or whatnot. So yeah, discussing the different options of mortgages. We talked about FHA, conventional, got into Home Ready, Home Possible, a couple lower down payment programs, discussed a little bit about MHFA, the $1,000 down program. And, if you have any questions regarding these mortgages that we're discussing, once again, you can always hit us up after the show, 612-207-5388. Again, 612-207-5388. MHFA Step Up program. I forgot to mention, yes, we have Chad Priebe with Bell Bank Mortgage in here with us. Again, thanks for staying for the second segment. So that Step Up program, how new a program is that?
It's been around. I mean, it's nothing new.
Wow.
So, yeah, phenomenal opportunity for a repeat home buyer. Everybody looks at MHFA, or I shouldn't say everybody, but most people think it's a first-time home buyer program.
Right. Well, I was under the assumption of that for a long time.
Right.
I didn't realize they had a secondary.
But they do. So they have a program out there. It's called the Step Up program. It's for someone that's owned a house in the last 3 years. Same situation. You don't have a ton of money in the bank for that 3% or 5% down payment, and it allows you to get into a house for $1,000 out of pocket.
So talking, we're discussing these lower down payment options, but they're not always right for everybody. That bringing that 5%, bringing that 10%, if you haven't, can actually be more beneficial because, correct me if I'm wrong, but can't you sometimes get better terms by going that route?
Exactly. That's a conversation that you want to have with your clients. And you can always look to a family member too, right? You have an option for a gift, right? Not a lot of people realize that grandma and grandpa or aunt or uncle or mom or dad are really happy for you to buy your first house.
Right.
Or your second house even. So maybe they'll be willing to gift you the money, because these down payment assistance programs are good if you're going to be in that home long term, because you have to make up that equity to pay for that second mortgage.
Right. Isn't there a
the
time
second
limit?
mortgage you have to pay back.
Correct. It's not a grant. You actually have to pay that money back.
Mm-hmm.
So it's a conversation I have with all my clients. Is there's always a pro and con to everything.
Right.
It just depends on your current situation.
Yeah, you got to be careful the advertising you see out there, right? A lot of advertising is geared towards one scenario, right? That zero closing costs. Well, you know what? Any loan officer that's worth their salt can probably put together a zero closing cost loan. It's just they're jacking up your interest rate.
Yeah, you're going to pay for it.
Or really low interest rate, right? Let's flip the coin. There's a really low interest rate advertisement out there. Well, guess what they're doing? They're building in points, okay? I mean, you got to look at who is the end buyer. I mean, your end buyer typically is Fannie Mae or Freddie Mac or, large institutions, and those rates tend to be pretty close. So, you want to take the time to learn, so that way you have the knowledge to pick what's going to be best for your situation, not just what an advertisement tells you.
Yeah, if there was one best loan out there, there would only be one loan out there. So
Right.
Yeah, we wouldn't be sitting here talking right now, would we?
Just one loan. This is it. Rural development. This is one that I think is underused, in my opinion. Like, if you go to pull up USDA, there we go. USDA Rural Development Map, you can see all the areas that this covers. And, you don't have to get too far outside the metro area. And this is a zero down loan. And, yeah, I mean, it's a pretty decent product. Once again, if you're having a hard time finding a place in the metro, especially like the market that's out there right now, hey, jump down to, Elko, Lonsdale, New Prague, up north of Forest Lake, out towards Minnetrista, push the limits a little bit. And first of all, you get more house for your money typically. And now you do have some great loan options too.
True zero down program.
Yeah, I mean, really, the only other zero down program is DVA, right, for veterans.
Correct.
Great program as well. I mean, if you're a veteran out there and you've not taken advantage of this, if you're renting, reach out, please.
Please do.
You know,
Take advantage of your benefits.
this is something, you know, I used my VA loan as soon as I was eligible
Absolutely.
to do so. So, all right, portfolio loans. Now, this is one where myself as a self-employed person, you know, these can be really helpful. Putting together options for a person who doesn't maybe really fit that typical box.
Correct.
You know, it's usually a higher down payment loan, but this is where, you know, certain histories that would normally be required may not be required, right?
Exactly.
It's much more like the old method of going to the bank and getting a home loan. You would go in, you would provide your stuff, and they would look at it, and then they would make a decision on if it's a good risk or not a good risk, right? It's not some computer, it's not some, somebody, and it's usually they're going to be kept in house, right?
Correct. And they're looking at compensating factors like assets, self-employment. How long have you been self-employed? They're looking at your profit and loss statements. They want to analyze your profitability in your business, and they're looking at the different risk factors. So you mentioned a good thing. If you are self-employed, this is a product that, if you can't get traditional financing, this is something that we can look at for you. If you had a bankruptcy within the certain time frames of, the Freddie and Fannie timelines, these are something as far as a portfolio product will offer that we could possibly look at your scenario.
Or maybe somebody's sitting with large cash assets, maybe a fixed retirement income,
Correct.
Don't fit into the normal box, but it would be crazy not to lend them money, but the underwriting of the traditional loans, it doesn't work.
Correct. Yeah.
So, like I say, it's much more like the traditional way that loans used to be given out. So looking at portfolio, and you know what, the interest rates are competitive.
Very.
Oh, yeah. I think I did 3 maybe last year portfolios.
Okay.
So, I mean, they're a good tool for the right people.
Absolutely. That's another tool to have in the toolbox. I mean, there's always going to be a need for that product for that special or specific person.
So let's talk about a fun one, which is how should somebody shop for a mortgage? We've got just a couple minutes left here. So I'm going to kind of run down this order. The first thing is apply right away. Okay, fill out the application, let them run your credit. Like I said at the beginning of the show, if you're all worried, wrapped up about the impact that's going to have, if you're shopping a few places, the impact is going to be minimal. It's going to roll off over a short period of time. Really, the key is to figure out your situation, right?
If you start early, you might be able to find a way to reduce or to increase your credit score.
Right, and well, that's a lot of the time what we're looking at, right? Hey, can you pay off this credit card that has this balance, or can you take care of this, take care of that, to help your score? Right. That's going to far outweigh any impact typically that inquiry is going to usually have. So, apply right away. If you don't, that would be like going in to a surgeon saying, hey, I want you to perform surgery on my arm. And they go, well, why? Because it hurts. And you point, and it hurts right here, right? Well, they're not going to do that, right? Going into a loan officer and say, hey, what loan should I get? Without them doing that is the same kind of thinking, right? So apply right away. It's going to help you. It's going to be beneficial. Then what you're going to want to do is you're going to want to identify the property type, the amount of down payment that you're going to make, the term of the loan. You want to talk about saving big bucks? Look at how much interest you'll save by switching from a 30 to a 20-year. And no, it doesn't cost you that much more typically, depending on your mortgage amount. You're going to save a ton of money. Then you look at the mortgage insurance. And is that something you can have taken off of there? And hey, guess what? If you do a single premium option, that's going to usually cover your amount from going to a 30 to a 20 in the median sale price range here in the Twin Cities. So right there, boom, saving money. You're going to look at the closing costs. Then, because all those other things that I just named off affect the interest rate, now it's time to look at the rate. If you're shopping rate first, you're shopping in the wrong order and you're not being the smart home buyer. So switch it around and you'll be doing really good. Have any questions for us? Give us a call. Happy to help you out. 612-207-5388. Again, 612-207-5388. If you'd like a copy of our book, The Smart Home Buyer 2.0, check us out at housegeeks.com. We'll be back next week. Bye, Facebook.